Are you thinking about buying, or are you one of those waiting for interest rates to get lower? Well, today I'm going to give you a couple things to consider if you're on the fence. Roll the intro. Recently, I've been getting a lot of questions. Should I buy now or wait till interest rates get lower? I'm Damien L.Grant, a licensed mortgage advisor, and today I'm going to give you a few of my top reasons why you want to consider buying now versus waiting. The housing market has new home buyers and investors excited about this low interest rate environment. But most buyers are not exactly sure when the right time is to commit to a new purchase. And a lot of home shoppers are waiting to see if market rates will drop again despite rates being at near record lows. Freddie Mac recently reported that over the last 45 years, rates have ranged from 18% to 3%, with rates on a decline since the early 2000s. The fact is that the 30-year fixed rate mortgage fell to a record low of 2.98% just a few months ago, which is having many buyers continuing to ask, will rates drop again, or is now a good time to buy? Well, if you're one of those potential buyers, here are 4 reasons why jumping in is better than waiting to react to the market. And since price is always the primary factor when making the purchase, let's start there. The bottom line is that home prices are continuing to rise. Forbes recently stated that statistically, current median listing prices are about 5.6% higher than they were 1 year ago. Compared to interest rate trends reported by Freddie Mac that house prices have actually doubled since the early 2000s. This means buyers looking to time the market might find it difficult to buy low. And while the US economy continues to battle COVID-19, inventory will remain low, further fueling shortages and pushing home prices higher. On the plus side, if you're looking to sell your existing home while purchasing a new home, which is very common in real estate, there has never been a better time to sell. Again, inventory is short, meaning that the houses that are available on the market are selling faster and at a premium. And sellers relying on net equity for their new purchase may be able to put more down on their new home, or increase their purchasing power by putting less down and increasing their overall amount financed. So let's jump into a quick example. Let's say you sell your home for $200,000 and are looking to use the net equity on the down payment for your next home purchase. A 20% down payment on another $200,000 home will require about $40,000 out of pocket, compared to if you put down 20% on a $400,000 home, it would be $80,000 out of pocket. Now, at first glance, the more expensive home seems less affordable. However, if you receive more money from your sale, instead of putting it towards a comparable price home, you could put less down on a more expensive home. So instead of putting 20% down, maybe only put 10% down. This makes the down payment requirement the same $40,000 for both the $200,000 home and the $400,000 home, with the added benefit that you get more home for your money. Now, speaking of purchasing power, let's consider interest rate fluctuations. Using the purchase prices from the previous examples, if you're looking to buy and not paying cash for a new house, most likely you need a new mortgage. And when financing a home, it makes sense to want a low mortgage interest rate. So let's consider the home with the $200,000 purchase price and an average interest rate of 3% given the current market. A 30-year fixed rate mortgage loan in the amount of $160,000 at 3% would put your principal and interest payment at $674.57 a month. Now, if you waited to see if rates dropped to near record lows again, the same mortgage with a rate of 2.5% would have a principal and interest payment at $632.19 a month, a savings of $42.38 a month and $508.56 a year. Now, is $42.38 a month worth waiting for rates to go lower? Waiting and betting that rates will continue to decrease when in all actuality, rates can really only increase. So keep that in mind. Now, another reason you definitely want to pay attention to is the housing market is holding strong. The calendar year for 2020 is almost over, and the housing market has shown tremendous signs of strength following the economic shutdown. As the housing market recovers, the Federal Reserve will ease back at relief measures and potentially allow for interest rates to increase. So if rates increase to the annual average set in 2018 for a 30-year fixed rate mortgage, which was 4.54%, your estimated principal and interest payment would be around $814.50 per month, an increase of $193.93 on our original $200,000 home price. So what do you think? Buy now or wait for rates to go lower? Leave it in the comment section below. So if you like this video, smash that like button, subscribe, share it with your family and friends. Comment below on how helpful you found this video and what your biggest takeaways were. I look forward to receiving your feedback and giving you some responses as well. I'll see you on the next video, and thanks for watching.